It is now time to turn our attention into nominal exchange rates. That is, the amount of one currency that you need to give up in order to get 1 unit of another. In these tables, you can find many examples of exchange rates between different currencies and the US dollar, as reported in the Wall Street Journal by February 17th in 2016. As it can be observed, there is a large degree of heterogeneity. In this chapter, we will focus on what economic theory has to say regarding the behavior of exchange rates. Note that nominal exchange rates vary considerably across countries and also vary quite a lot across time. In this chart, we can trace the time evolution of 4 currencies against the US dollar between 1950 and 2010, relative to the exchange rate that was in place in 1950. We can see that the amount of renminbis that are needed to purchase 1 US dollar has increased almost threefold in this period. On the other hand, the building of the Eurozone led to convergence criteria that were the goals of the Euro area countries' policies. This led to the convergence of nominal exchange rates up to 1998, when the euro was created and exchange rates were fixed. From that point onward, Euro area countries had only one exchange rate against the dollar, there depicted for the period 1950 to 2011. So what explains these dynamics? We are going to build a basic framework of analysis to see what economic theory has to say about both the level and changes to nominal exchange rates over time. Let's start by some basic assumptions. Each country issues and uses its own currency instead of using a common currency. To keep things simple, pretend that there are only 2 countries. Think of the home country as the United States and the foreign country as the United Kingdom. The US nominal quantity of money M is measured in dollars. The UK nominal quantity of money, MF, is measured in pounds. There is a currency exchange market on which participants trade the currency of one country for that of another. We define the exchange rate, or more precisely, the nominal exchange rate, to be the number of pounds received for each dollar. Let epsilon denote the nominal exchange rate between pounds and dollars. Sometimes countries allow their nominal exchange rates to move freely in response to market forces. These systems are called flexible exchange rates. In other circumstances, countries try to maintain a constant nominal exchange rate with respect to another currency, often the US dollar. These systems are called fixed exchange rates. Let the US price level P be measured in dollars per unit of goods. We denote the UK price level, or foreign price level, by PF, measured in pounds per unit of goods. Assume that the goods produced and used in both countries are physically identical. We also ignore any transportation or other transaction costs for buying and selling goods in the 2 countries. In this context, the law of one price should hold. That is, the quantity of goods that can be bought in the US should equate the quantity of goods that can be bought in the UK after trading dollars for pounds. If not, let's say that you could buy more goods by trading dollars for pounds and buy the goods in the UK. Then the demand for pounds would increase and the pound would appreciate vis-à-vis the dollar, up to the point where this equalization would occur. This is essentially a no-arbitrage argument. This result allows us to formulate our first prediction regarding the value of nominal exchange rates. The nominal exchange rate will be whatever it needs to be such that a given currency has the same purchasing power after it is converted. We call this the absolute purchasing power parity theory of nominal exchange rate determination. This implies that the real exchange rate, the ratio of goods that can be bought in the United Kingdom, say with $1, two goods that can be bought in the United States also with $1 is equal to 1. How is it in reality? Are real exchange rates equal to 1 across countries? Actually, no. One can find considerable deviations from that value in many cases. However, we can see a pattern in this table. Real exchange rate deviations from 1 tend to be larger in less developed countries. Note how the Netherlands, Ireland, Belgium, Canada, Germany, France, and others had in 2014 a real exchange rate with the US very close to 1. The largest deviations were found to be for countries like India, Iran, and Pakistan. This pattern led to the formulation of the Balassa-Samuelson hypothesis, named after Bela Balassa and Paul Samuelson, notorious economists, the latter being a Nobel laureate, for the scientific work through which he has developed static and dynamic economic theory and actively contributed to raising the level of analysis in economic science. But back to our pattern of real exchange rates. The Balassa-Samuelson hypothesis postulates that real exchange rates tend to be higher in poorer countries due to the lower price of non-tradables in those economies. This is rather intuitive. Since these goods like housing, restaurants, or haircuts are not traded internationally, the law of one price does not apply, and the lower level of development in these countries deem this service to be cheaper because of cheaper labor. However, these differences in development tend to be very persistent through time, which means that if the law of one price doesn't lead to purchasing power equalization through pressure on nominal exchange rates, at least the changes in nominal exchange rates should reflect changes in price levels over time. Assuming, as we mentioned, that the differences in the level of development that led to deviations from absolute purchase power parity are roughly constant in the medium run. More precisely, we postulate that nominal exchange rates follow inflation differentials. We call this the relative purchasing power parity theory of nominal exchange rate determination. This leads to another prediction, that the growth rate of real exchange rates should be 0. Is this the case? In this table, we show inflation rates differentials and the growth rates of nominal and real effective exchange rates. Effective means that instead of looking at a country exchange rate against another single currency, we look at a basket of currencies weighted by their importance in trade volumes with the country at stake. As we can see in this table, the growth rate of real exchange rates are indeed relatively small and suggests that this theory does hold some empirical plausibility. This is even more striking if instead of looking at developed economies with low inflation, we look at mostly middle-income countries during high inflation periods from 1960 to 1996. As we can see in this table, the growth rate of nominal exchange rates follow very closely inflation rate differentials, leading the growth rate of real exchange rates to be comparatively very small. One can use a similar argument to equate returns on bonds across countries. If faced between the choice of holding a US bond or use the exchange rate market and hold a UK bond, trading it back at maturity, no arbitrage leads to interest rate parity. This means that the real returns in these two investment options must equate, which approximately implies that the growth rate in the nominal exchange rate equals nominal interest rate differentials. Again, this formalizes the argument that for two interest rates to offer the same deal, to have parity in the returns offered on bonds in the two countries, the difference in nominal interest rates has to compensate for the expected growth of the nominal exchange rate. A number of real-world considerations prevent interest rate parity from holding exactly. For example, through uncertainties about asset returns and exchange rate movements, the tax treatment of interest income, government restrictions on currency exchange, and asset flows across international borders. For the main developed countries, departures from interest rate parity are sometimes substantial in the short run, but in the long run they tend to be small. Note also that from relative purchasing power parity theory of nominal exchange rate determination, we had found that the growth rate in nominal exchange rate equates inflation differentials. So these results together imply that nominal interest rate differentials equate inflation differentials. We can rewrite this to show that this implies that expected real interest rates are equalized to